Anup Maheshwari, Executive Vice President and Head of Equities along with Corporate Strategy with the DSP Blackrock Investment Managers. Anup, morning. Thank you for joining us. Anup, despite adverse news flow, challenging environment and a tough global situation, Indian markets are holding on and we have not gone back or retested December lows. So what is driving the inherent strength?
Yeah, absolutely. I think one clear thing that we've seen, at least in the last few months, emerges. We were looking for a catalyst for things, for the bad news to turn, or for the macro to potentially stop deteriorating. And I think one clear catalyst for that, which you mentioned earlier, is the currency. The fact that the currency has lost a lot of value actually means that we're now at a stage where we can start repairing at least the macro perspective, starting with the current account deficit, which is clearly going to improve now. So that, in that sense, at least there's one sort of positive change on the macro side. I think that's also now hopefully being backed up by some more aggressive moves by the government. At least they're going a lot more public. They all realize what the issues are. I think we just need to convert it into some action, and hopefully we'll see some. So I think that combination from a macro perspective, the realization that something needs to be done, I think should hopefully, improve at least the top-down sentiment. On the bottom-up front, though, there's still challenges. I think this is going to be another tough corporate earnings year. It's a lot of companies that we're talking to are obviously still facing the after effects of a poor macroeconomic market. But as long as things gradually start repairing themselves and getting better, I think by default eventually corporate earnings will also later on improve with a lag. So our sense is this is still a market where your patience will be tested. It's not a market to expect dramatic moves in very short periods of time. Sentiment, of course, in the short run can drive things. It's a very liquid market, so short-term moves are clearly the name of the game. But I think for the more structural market behavior, we think it'll still take a little while. So we still need to pass a bit of time. But you can see things improving eventually, simply because the repair process has started. So that's giving us a little more optimism.
Anup, as of now, you are of the view that event-related volatility is likely to persist. When do you expect things to improve, really?
Well, listen, we're definitely hopeful. We're always eternal optimists in some ways, and there have been many false starts by the government. We know there are lots of issues, but I think, as I said, everybody sort of picks up the paper and reads the same stuff or watches the same sort of issues on the channel, and is fully seized of the problem. So we're just looking at more recent sort of developments in the government, and are hopeful that maybe this is marking a bit of a change in stance in terms of how the government's going to approach this whole situation. So from a macro standpoint, hopefully the right noises will be made and things will improve. So I think between now and the next couple of months, we need to keep a close eye on that.
Anup, HUL was your top holding in the December quarter. BPCL is your largest holding as per your last declared portfolio. So obviously you are churning your portfolio. So what makes you bullish on energy and what makes you bearish on defensive stocks?
Well, we're always focused on sort of value for the business that we're buying, and clearly we do see, irrespective of the market mood generally, the fact is there are always some pockets of value somewhere or the other. And you need to keep adjusting your portfolio to some extent, as things change. Now, the fact that hopefully, interest rates are not likely to rise significantly from here is giving us some confidence to look back into, the more economy-sensitive businesses. And we've been doing that for some time now. This is not a new thought. And therefore, we started adjusting the portfolio, the mix a little bit from a pure defensive orientation towards a more balanced orientation. A lot of that is very stock specific. So for instance, you mentioned in energy, we're looking at companies in the refining and marketing space as well. And even in commodities, if we find stocks at significant discounts to book value, we're definitely keen on taking a look. Even though our commodity outlook per se is not great, But sometimes, it's a general fact known to everyone, and to some extent it's in the price, which is why these stocks are trading the way they are. So we've got to take a call at a price at times like these, and not get too obsessed with the negative news floating around.
Anup, so do you think Indian markets will bottom out irrespective of what is happening in Europe? Because so far that seems to be the trend.
Well, I wish I knew, Nikunj, but there's so many moving parts in the international markets that it's very difficult to predict. The good part, again, I keep repeating this, is however much we may be talking about Europe, for instance, everybody's fully seized of the extent of criticality. There are enough people who have also written it off, and therefore to some extent it's already reflected in markets. And if you look at Greece, for instance, from the start of the year to now, has underperformed, let's say, Germany by 40%. So, people are pricing in some of these events, and more often than not in the past we've seen whenever the actual event occurs, it's pretty much the bottom of the market, or if the market's already discounted a lot of that. So I think we need to just disassociate between the news that we're going to hear from a macro point of view versus how the markets could potentially behave. And it still looks like from a macro perspective globally things will remain sluggish. I think that's pretty much a consensus view right now. But I don't think markets necessarily will behave exactly the same way.
Anup, German bonds are nearing 1% and US Treasuries are nearing 1.5%. Do you think at these levels the world is pricing in too much of risk, which may not really sustain?
Well, I think so. I'm not sure where it will flow, but the fact that these assets are overpriced is definitely quite visible. US bonds are trading at sort of 200-year lows. I think in terms of their yields, none of these I think are long-term sustainable factors. We know that whenever things happen to an extreme, they tend to work for a while but don't sustain. So we don't see this being a long-term phenomenon. Now the problem is definitions of long-term can be very different for different people. 6 months may feel like an awfully long time, but it can continue to be the case. But if you just look at it through a cycle, it's quite safe to say that these are not sustainable. So our sense is the crowded trades invariably make money for a while, but over time cannot make disproportionate amounts of money by their very nature. The fact that they're crowded will not allow it to make money, and therefore we'd be quite skeptical long term on these sort of aggressive extreme views. And I think money will generally flow back to equities at some stage as an asset class. Now, how much of that will be in developed markets, emerging markets, is really a function of how these economies perform over time. But from bonds to equities, I think is definitely a trend we can see at some stage.
Right. So, Anup, over the years I've known you, you've always managed to stay ahead of the curve. So at these levels, where are you allocating this proportionate amount of money? I mean, your last call was to buy HUL, which worked like a charm, and the second one was BPCL, and BPCL this year has been an exceptional outperformer. So where is Anup Maheshwari allocating money?
Yeah, but again, it's a timing thing. If you ask me what's my confidence of it picking up right away, the answer is fairly low, just like anybody would normally expect. These things take time. But the fact that we've had a very optimal investment or capex in the last 2-3 years does lead us to believe that there's a lot of pent-up capex. Now, it's not going to come through immediately. I think there are too many issues. Confidence takes time to come back. Policies have to be put in place. So I think you'll see the cycle pick up at some stage. We can't define when. In a portfolio you can't be extremely positioned. You always have to have a bit of a balance, and therefore we're looking at some of the good quality names in that sector that we're willing to hold, and we have to be patient. I mean, these won't necessarily yield us returns immediately, but over time it will.
So Anup, what is your view on the Indian rupee, and do you think it will stabilize at the current levels?
Yeah, I think currencies are important, clearly playing a big role as far as markets are concerned. So, currency appreciation is generally good for the underlying market. And, we're hopeful somewhere down the road. I mean, the rupee, frankly, today is not given much confidence in its behavior. But we do think it should sort of stabilize around this level, hopefully. And that is another factor that probably foreign investors need to think about when they're investing into the Indian market. The fact that the currency has already lost 20% in the last 12 months alone.
So, Anup, does the current market environment remind you of 2003 or what we saw in 1997? The macro was bad, everybody hated India, but valuations were extremely attractive.
Yeah, I mean, we've seen these phases, I guess, that time, yes, and also a bit like the mid-90s. I mean, we've had, these situations keep coming again and again. That's the beauty of markets, and hopefully the value of experience. These are very similar characteristics of the 90s, or a good part of the 90s, and also, like you mentioned, that 2001-2003 phase. And there are subtleties to every phase. Circumstances tend to be a little different, but the market behavior broadly tends to be similar. So we do think it's one of those phases. Now, if you go back to 2001-2003, while you were living through it, it was really awkward and testing, as it is today. But sitting here today, that looks like a phase where it made a lot of sense to invest on hindsight as well. So you've got to somehow just look beyond, I guess, the immediate clouds and look beyond them and the potential for corporate earnings.
Anup, final question. Even though you're a hardcore equity guy, at these levels, is there merit in investing in fixed income products? Because it's a matter of time. Reserve Bank of India will cut rates, and when that will happen, normally debt market instruments, they tend to outperform.
No, I think there's definitely value in fixed income as well at this point. So, this is all part of asset allocation. I think you can't be, only in one and not the other. But for fixed income, clearly, if interest rates do start heading down, and that's a big if, though, given inflation and everything else in terms of the magnitude of correction in interest rates. But if interest rates, in any case, are at least stable and marginally declining, I think that is generally positive for bonds, particularly long-term bond funds. So I think there is value to owning bonds to some extent in the portfolio. It's part of asset allocation. And at the same time, equities clearly is more about just investing regularly, so that sometime, and we've seen this again and again, at some point in time, if you get a bull market, it covers up for all your past patience of holding on and not making returns for a fairly long period of time. So will we get a phase like that somewhere in the next few years? Hopefully, yes.
Okay, Anup, good to have you on the show. Thanks very much for taking time out as always.